3 dividend ETFs that could replace your full-time job. Imagine waking up every morning knowing your money is working for you, generating cash flow without you lifting a finger. Sounds too good to be true? But with the right dividend ETFs, it's not. And here's the kicker. With just a $10,000 investment, this strategy has the potential to snowball into a portfolio that pays you $4,700 every single month. Let's break down exactly how it works. In this video, we're talking about 3 of the best dividend ETFs, ones that don't just pay you now, but also grow your wealth over time. We'll break down how they make money, why they're so reliable, and what makes them a no-brainer for long-term investors. Stick around, because by the end, you'll see how just $10,000 could turn into $4,700 a month in dividends, enough to replace a full-time income. Let's dive in. You're probably wondering, why dividend ETFs? Thing is, one of the biggest advantages of dividend ETFs is diversification. Instead of relying on a single company to deliver returns, you're spreading your investment across dozens, sometimes even hundreds, of high-quality dividend-paying stocks. This reduces risk and helps create a smoother, more predictable income stream. That's why many investors turn to dividend ETFs, not just for long-term wealth building, but as a way to replace their full-time income. You too can achieve it. First step? Let's dive into the SPDR S&P Dividend ETF, a fund that epitomizes the essence of dividend investing. SDY. SDY's strategy is straightforward yet powerful. It focuses on companies within the S&P 1500 Composite Index that have consistently increased their dividends for at least 20 consecutive years. This approach highlights firms with a proven track record of rewarding shareholders and also emphasizes financial stability and resilience. SDY's holdings are a strong mix of some of the most reliable dividend payers in the market. Realty Income Corp leads the fund with a 2.80% weighting, followed by Kenvue Inc. at 2.37%. Other major players include IBM, Xcel Energy, and Edison International. This diversification selection ensures a steady stream of dividends from multiple industries. When you break down SDY's sector allocation, you'll see it spread across some of the most reliable income-generating industries. Industrials lead the way at 18.34%, followed by financial services at 15.63%, and consumer defensive at 14.27%. It's clear SDY leans heavily into those classic dividend-paying sectors, making it a solid choice for steady income. Now, an essential consideration for any investor is the cost of investment, and SDY maintains an expense ratio of 0.35%, which is relatively modest and ensures that a larger portion of returns remains in the investor's pocket. Now let's talk numbers, because this is where SDY really shines. First up, the dividend yield sits at a solid 2.98%. Meaning investors are getting a steady stream of income just for holding the fund. But here's where it gets even better. Those payouts aren't just staying the same, they're growing. SDY's dividend growth rate averages 6.98% per year, which means your income potential keeps increasing over time. As for share price growth, historically, SDY has delivered an impressive 10.3% annual return. That's the kind of performance that not only generates passive income, but also builds real wealth. Imagine putting in just $10,000 and letting time do the heavy lifting. In just 5 years, that investment could grow to nearly $19,000, and you'd already be earning around $600 per year in dividends. Not life-changing yet, but this is just the start. Fast forward 20 years and things really pick up. Your portfolio could be sitting at $146,000, and your annual dividend income would be around $6,750. That's $560 every single month. At this point, your dividends alone could cover a car payment, some bills, or even a vacation. But here's where it gets crazy. After 30 years, your portfolio could skyrocket to a massive $681,000. And your dividends? A jaw-dropping $42,000 per year. That's over $3,500 every single month in completely passive income. This is the magic of long-term investing and reinvesting dividends. The earlier you start, the bigger the snowball gets. So yes, SDY builds the foundation with reliable, time-tested dividend payers, and it already cranks out nearly $3,500 a month in passive income. But we're just getting started, because the next ETF, it's about to take your income to the next level. DGRO. The iShares Core Dividend Growth ETF, DGRO for short, is all about finding the perfect balance between dividend yield and growth. Instead of just chasing high-yield stocks, DGRO focuses on companies that have consistently grown their dividends for at least 5 consecutive years. This means you're not just collecting income, you're investing in companies that are committed to increasing their payouts over time, which is a crucial factor for long-term wealth building. Looking at the top holdings, DGRO is packed with blue-chip giants that dominate their industries. ExxonMobil leads with a 3.03% weighting, followed closely by JP Morgan Chase at 2.98%. Tech powerhouses like Apple and Microsoft also make the cut, proving that dividend growth isn't just for traditional sectors. When it comes to sectors, DGRO has a solid mix. Financial services lead the way at just over 20%, giving it a strong foundation. Then you've got healthcare at 18% and tech at 17%, adding both stability and long-term growth potential. Industrials and consumer defensive round things out with a steady balance, making this ETF a great blend of reliability and opportunity. Now, with an ultra-low expense ratio of just 0.08%, DGRO lets investors keep more of their returns while benefiting from a disciplined, growth-focused dividend strategy. Now, let's break down the metrics for DGRO, because this is where things get really exciting. First, the dividend yield comes in at 2.36%. Of course, this is a solid, steady payout that puts cash in your pocket while you hold the fund. And with an average annual dividend growth rate of 5.25%, your income stream keeps increasing year after year. For share price performance, historically, DGRO has delivered a fantastic 13.6% annual return. That's the kind of growth that not only generates passive income, but also builds wealth at an impressive rate. Say you put in $10,000 and let time do the heavy lifting. You would be amazed at the turnout. Let's begin at the 5-year mark. Your investment could already be pulling in $480 a year while growing to over $21,000 in value. But here's where it gets exciting. Fast forward 20 years and you're looking at a portfolio worth $218,000, generating $7,000 per year, or nearly $600 every month in passive income. Now, if you stick with it for 30 years, the numbers go through the roof. Your portfolio could skyrocket past $1.1 million, and your annual dividend income? A jaw-dropping $47,000. That's over $4,000 per month in cash flow. Earning $4,000 a month from DGRO is already amazing. But what if I told you the next ETF could take it even higher? Stick around, because by the end, you'll see how this final piece of the puzzle can help you completely replace your full-time job with passive income. Pay. Pay is another powerhouse for anyone who wants strong, consistent dividend income. This ETF is all about high-yield stocks, focusing on companies that have a track record of not just paying dividends, but offering some of the best yields in the market. It's built for investors who want steady cash flow without chasing risky, unproven stocks. But what makes Pay stand out is its commitment to quality and yield, bringing together companies that reward shareholders generously. Looking at its holdings, you'll see a mix of well-known names. Walgreens Boots Alliance is at the top, followed by Invesco Private Prime Fund, Altria Group, and Verizon Communications. These are companies with solid business models and strong cash flows, which help ensure those dividends keep coming. The sector breakdown is also interesting. Utilities lead the way, making up nearly a quarter of the portfolio, followed by financial services and consumer defensive stocks. This means stability, even in volatile markets. The expense ratio is just 0.52%, which is technically higher than some broader ETFs. But for an income-focused strategy like this, Many investors actually see it as a fair trade-off for the high-yield exposure. This brings us to the good part. Pay is built for dividend lovers, and the numbers prove it. With a solid 3.81% dividend yield, it offers one of the highest payouts among dividend ETFs. That means more cash flow hitting your account, whether you reinvest it or use it for income. But it's not just about a high yield. Pay also delivers growth. Over the years, its dividends have grown at an impressive 7.26% per year, meaning your income stream has the potential to outpace inflation and keep compounding. Let's also talk about price returns. With a historical annual share price return of 10.4%, you won't just be collecting dividends, you'll also be building long-term wealth. Now, imagine putting $10,000 into Pay and just letting time and compounding do its thing. In just 5 years, your portfolio could nearly double, reaching $19,600, while your dividends start bringing in about $700 per year. A nice little boost, but just wait. Fast forward 20 years and things have picked up. Your portfolio could be sitting at $173,000, while your passive income jumps to $9,000 per year, or $755 per month. That's already enough to cover major expenses without lifting a finger. Now, if you stay the course for 30 years, the numbers get even crazier. Your $10,000 investment could explode to $859,000, while your dividends skyrocket to $57,000 per year, or $4,700 per month. That's a full-time income without the full-time job. This is the true power of long-term investing and dividend reinvestment. And there you have it. 3 dividend ETFs that can pay you more than a full-time job, all while you sit back and let your money work for you. No stress, no complicated strategies, just time, compounding, and steady dividend growth doing all the heavy lifting. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.